What if I told you that one of the most popular financial strategies in America isn't an investment at all? It's a debate that's been going on for decades. Should you buy permanent life insurance, or should you buy term insurance and invest the difference? Today, we're going to examine both the advantages and disadvantages of the buy term and invest the difference strategy so you can decide whether it's right for you. Let's dive in. The concept is simple. Instead of purchasing a more expensive permanent life insurance policy, such as whole life or indexed universal life, you purchase an affordable term life insurance policy. You then invest the money saved from the lower premium into investment accounts, such as a 401k, Roth IRA, traditional IRA, brokerage account, mutual funds, or ETFs. The theory is that over time, the investments may grow enough to create more wealth than the cash value inside a permanent life insurance policy. Sounds great, right? Well, like every financial strategy, there are benefits and drawbacks. Let's start with the advantages. One of the biggest advantages of term insurance is affordability. For the same death benefit, term insurance is often significantly less expensive than permanent life insurance. For example, a healthy 35-year-old may be able to purchase a $1 million term policy for a fraction of the cost of a permanent policy. That lower premium creates more available cash flow for investing. Advantage 2, potential for higher investment returns. Historically, diversified stock market investments have produced attractive long-term returns. If the money saved is consistently invested and remains invested over decades, the accumulated value could potentially exceed the cash value accumulation of some permanent life insurance policies. However, remember the key word, potential. Returns are never guaranteed. Advantage 3, flexibility and control. With this strategy, you maintain control over your investments. You can choose stocks, bonds, ETFs, or mutual funds. You can also adjust your strategy as your goals evolve. Many investors appreciate this flexibility. Advantage 4, more coverage for less money. Because term insurance is less expensive, families can often purchase a larger death benefit while staying within budget. This can provide significant protection during important years when children are young, mortgages are large, and retirement assets are still growing. Advantage 5, simplicity. Term insurance is straightforward. You pay a premium. You receive coverage for a specified period. There are fewer moving parts compared to many permanent insurance products. Now, let's examine the drawbacks. Disadvantage 1, it requires discipline. This may be the biggest weakness of the strategy. The strategy only works if you actually invest the difference. Many people buy term insurance, but spend the savings instead of investing it. If the money isn't consistently invested, the strategy breaks down. The success of buy term and invest the difference depends heavily on personal behavior. Disadvantage 2, market risk. Investment returns are not guaranteed. Markets fluctuate. Recessions happen. Bear markets occur. If your investments perform poorly, the projected outcomes may not materialize. Unlike guaranteed insurance benefits, investment returns carry risk. Disadvantage 3, coverage eventually expires. Term insurance is temporary. When the term ends, coverage may disappear. Renewal costs may increase significantly, or health changes could make new coverage difficult or expensive. This is one of the most common concerns with relying solely on term insurance. Disadvantage 4, no cash value. Term insurance provides pure protection. It does not accumulate cash value. If the policy expires without a death claim, there is no policy value remaining. Some people view this as efficient. Others view it as a drawback. Disadvantage 5, assumes perfect execution. Many financial illustrations assume consistent investing, no emotional decisions, no missed contributions, and strong market performance. Real life rarely works perfectly. Unexpected events, market declines, and behavioral mistakes can impact outcomes. Who might benefit most? Buy term and invest the difference may work well for young families and budget-conscious individuals. Disciplined investors, people maximizing retirement accounts, and those comfortable with market risk. Who may want to consider other options? Permanent life insurance may deserve consideration for estate planning, business succession planning, high-income earners seeking tax advantages, legacy planning, and individuals wanting permanent death benefit protection. There is no one-size-fits-all solution. So, is buy term and invest the difference a good strategy? The answer is, it depends. For disciplined investors who consistently invest and stay committed through market cycles, it can be a powerful wealth-building approach. For others, permanent life insurance may provide benefits that align better with their goals. The best strategy isn't the one that's most popular. It's the one that supports your family's objectives, risk tolerance, and long-term financial plan. Before making any decision, understand both the advantages and disadvantages and evaluate how the strategy fits your overall financial health. Because good financial decisions aren't about products, they're about purpose. And that's what financial planning is all about.